question isn't, are we going to have a recession? The question is it going to be a depression? I mean, if we just get away with a recession, we're getting off easy. But I don't think there's any way that the payoff, or the payback rather, for over a decade of 0% interest rates and massive quantitative easing, I don't think we're going to get away with just a mere recession as a result of that. It's going to be a depression, and I think it will be worse than what is known as the Great Depression, the one that we experienced during the 1930s.
Stock markets have fallen on Monday morning as recession fears continue to grow. Are these fears warranted? Well, the S&P 500 is down 0.5%, with the NASDAQ down about 0.8%. Peter Schiff joins us to break down market action and his outlook for the economy. Peter Schiff is the Chief Market Strategist of Euro Pacific Asset Management. Welcome to my new show. Peter, honored to host you.
Well, I'm glad to be here, David, and congratulations and good luck with the new format.
Thank you very much. One of the more famously correct calls you've made in your career is prior to 2008, you were warning that 2008 would happen and that the banking crisis would unfold the way it did, more or less. And you were correct then. Let's see what's happening today. I'm just going to quote a report from Morgan Stanley that's been making the rounds on the news. That's rather alarming. Morgan Stanley strategists said that more than 50% of the $2.9 trillion in commercial mortgages will need to be renegotiated in the next 24 months. And they said that peak to trough CRE commercial real estate prices may decline as much as 40%, which is worse than in the great financial crisis. So let's break this down, Peter. Let's assume they're right. The question is, are housing prices in a bubble? Will they collapse? And two, how exposed are the banks?
Well, the banks are very exposed, and anything that was interest rate sensitive is in a bubble, because we had interest rates at zero or practically zero for over 10 years. And so during that period of time, a lot of debt was taken on to buy a lot of assets. And because the interest rates were so low, people buying those assets could overpay. And so it was the low interest rates that helped to inflate the bubbles. That's the same thing that happened in the bubble that popped in 2008. And one of the reasons I was able to see it so clearly before it popped is because I recognized how Fed policy had inflated it. And, even before that bubble popped, I was forecasting the next one, which is the one that we've been living in for that entire decade. The only thing that's surprising to me is not that it's deflating, but that it took so long. But the current banking crisis is just another financial crisis. It's caused by the same factors that caused the last one, which is the Fed and its easy money policies, quantitative easing, 0% interest rates, except this time the Fed succeeded in inflating a much bigger bubble than the one that popped in 2008. And I think the 2023 financial crisis is going to be a lot worse than the 2008 financial crisis. And it's probably not going to end in 2023. It's probably going to bleed into 2024.
In what way will it be worse? Are you saying that it's not just the banking sector that's going to be affected?
Well, every segment of the economy took on too much debt. Now, obviously, the banks are very vulnerable because the banks own a lot of that debt. But corporate America is in a lot of trouble. Where do you think corporations got the money for all these share buybacks? Most of it was borrowed, and a lot of those loans are going to come due. So it's not just the commercial real estate sector, but corporate America that's in trouble. And Americans also have record debt. We have credit card debt, student loans, auto loans, mortgage debt. None of this debt would be anywhere near as large if it wasn't for how low interest rates were, because that's what made the payments affordable. But as interest rates reset, the payments become unaffordable. And the other problem is the buyers of these mortgages and bonds. I was pointing this out for years before Silicon Valley blew up, but I was warning about the impact this was going to have on banks and every other creditor when interest rates inevitably rose, and they would have to rise much higher than anybody thought because inflation would be a much bigger problem than anybody imagined, but that this would result in significant losses for the lenders. And we're just seeing the tip of that iceberg now.
You told me something very important, Peter, a while ago, which is that interest rates rising is inherently inflationary because businesses will need to raise prices in order to combat rising interest expenses. Are they able to do that this time, Peter, though? Are they able to raise prices to maintain their margins going into what's possibly a recession?
Sure. Now, they may have to reduce their overall volume because as you raise prices, you price certain consumers out of the market. But companies have to operate at a profit. So maybe some of the marginal customers will drop off in a lower volume business, which means that those companies have to start reducing their overhead to start preparing for a profitability with lower sales. And that's what's ultimately going to happen in the recession. A lot of Americans are going to stop buying because they're broke, but the Americans that still can afford to buy will just pay higher prices in order to keep these businesses afloat. Because if a business can't make a profit, it's not going to stay in business.
I want to come back to the banking crisis and financial crisis that you're talking about. But since you brought up the recession, Peter, is there going to be a recession? Is my basic question. Let's start with that, and then I want to bring up some tweets that you made.
Well, I think that's a foregone conclusion. The question isn't, are we going to have a recession? The question is it going to be a depression? I mean, if we just get away with a recession, we're getting off easy. But I don't think there's any way that the payoff, or the payback rather, for over a decade of 0% interest rates and massive quantitative easing, I don't think we're going to get away with just a mere recession as a result of that. It's going to be a depression, and I think it will be worse than what is known as the Great Depression, the one that we experienced during the 1930s. And I think that the losses in banks will be a lot greater than it was in the 30s, not necessarily because the banks fail. They would fail if the government allowed them to, but because they're going to get bailed out with inflation. And because the government is going to have to print so much money to keep all these insolvent institutions afloat, the value of everybody's savings is going to sink. The dollar is going to collapse and inflation is going to run through the roof.
Okay, I want to talk about the labor market first because that is one series of data that's been confusing to some people, including myself. You tweeted about this recently. You said the only reason the March jobs numbers wasn't well below estimates was that government hired a lot more workers than expected. When the private sector creates jobs, businesses absorb the cost. I think you may be referring to the unemployment rate, Peter, that came out last week. Unemployment went down, not up, to 3.5% from 3.6%. Interestingly, the labor force participation rate continues to go up. So on paper, the labor market is improving, not deteriorating. Can you shed some light as to what's going on?
Well, the point I made with the observation in that tweet was that but for the big jump in government jobs, the jobs number would have disappointed because we created, I think, close to 50,000 government jobs. The private sector jobs were well below what had been anticipated. And my point is, this is not good news. I mean, if government bureaucracies are now even more bloated than they were because they hired more people, we're not better off because of that. In fact, we're probably worse off because they're going to make the rest of us less productive. And we have to pick up the cost through higher taxes or through more debt and inflation, as opposed to productive private sector jobs that pay for themselves. Because if a private company hires somebody, that doesn't affect me. I mean, I don't have to pick up the cost. I mean, the costs are paid by the business out of the profits that are being generated by that business and by that labor. So that's good if we have jobs created in the private sector. But when the government just goes out and hires people and I'm on the hook to pay their salary, I mean, that's not good news.
Right. Now, to your point about inflation being a part of this problem, recessions in the past have traditionally or historically been deflationary, if not just disinflationary. But you're saying that this one will be a depression and inflationary. Can you walk us through how that's going to work?
Well, I don't think recessions are deflationary. In the short run, if you go into a recession, there is going to be some kind of pullback in consumer spending. And there may be some businesses that fail And so as they're going out of business, maybe they'll have a sale. And so you could have some type of downward pressure on prices, maybe at the beginning of that recession as you're kind of entering it. But I think in general, economic downturns end up being inflationary, in that what happens is that you have fewer people productively employed, and so you're not making as much stuff. But as the economy contracts, governments respond to that contraction by pursuing highly inflationary fiscal and monetary policy. They increase government spending, the central banks print more money to buy up government debt, they try to encourage more consumption, and so all of this ends up pushing prices higher. And if you look historically at the worst episodes of inflation, they always take place when economies are in recession or depression. You don't have runaway inflation when times are good, right? It's always a horrible economy, a basket case with high unemployment that you see runaway inflation. And that, I think, is the environment into which we're headed.
Speaking of how high this inflation will get, you made another interesting tweet. Soon everyone in America will be a multimillionaire. Well, you got us in the first half, Peter. That's good news. Everyone wants to be a multimillionaire. But then you spoiled it for us, Peter. You said, don't get too excited. Chewing gum will sell for over $1,000 per pack. And all those higher taxes meant to soak today's millionaires and billionaires will drench tomorrow's middle class. What's your message here? We should avoid buying bubble gum, chewing gum?
Well, no, you should stock up on it now before it's $1,000 a pack. Although I don't know, maybe some of it gets stale. I don't know how long the shelf life is for chewing gum. I don't chew a lot of gum these days. But yeah, the point is that inflation is going to be rampant. I mean, that's just the way this is going to end up. There's no other politically viable alternative. I don't see the significant cuts to government spending that would be necessary to avoid much higher inflation. I don't see the Fed pursuing the type of monetary policy that would really be necessary to force the government into, making those difficult choices. I think all the factors are going to come down on inflation. They're going to keep on spending money. They're not going to cut anything. Everybody's going to get paid their Social Security benefits and their Medicare benefits and their pensions. The problem is the money's not going to buy very much, because if you need $1,000 to buy a pack of chewing gum, I doubt your Social Security benefits are going to keep pace with that. Even though they do have these cost of living adjustments, they're not going to capture anywhere near the degree to which the cost of living is actually going up.
High inflation usually doesn't happen overnight. There's a process involved. And this process usually involves a lot of money printing, which we've seen. However, Peter, the nation, I'm talking about the U.S., has never experienced hyperinflation before, but you've claimed, and I've seen your YouTube channel, which everyone should check out, great channel, you've claimed that perhaps we could potentially see a scenario in which the U.S. dollar reflects what's happened in, let's say, Zimbabwe. Walk us through your logic here and the process of getting there.
And it doesn't have to get as bad as Zimbabwe, right? That's a worst case scenario. I mean, maybe It'll just be like Argentina, which is pretty bad.
That's pretty bad,
right?
too,
But not quite as bad as Zimbabwe, or Weimar Republic Germany. I mean, you have these examples of severe hyperinflation. But I think there's no question that we are going to suffer very high inflation. Whether it ends up being the type of inflation, where we're all trillionaires, because everybody in Zimbabwe, it's not they're all millionaires, they're all trillionaires, right? But what good is $1 trillion Zimbabwe dollars? Doesn't even buy you a pack of chewing gum for $1 trillion Zimbabwe dollars. Maybe you could get a stick, I'm not sure. So I don't know that it's going to be that bad, but it's going to be very bad. Certainly it's going to be on an order of magnitude far greater than what Americans experienced during the 1970s. In fact, I think 2021 was as bad, if not worse, than any year of the 1970s. We just didn't measure prices as accurately in 2021 or 2022 as we did back in 1978, 1979, those years where inflation was very high, or throughout the whole decade. So I think it's already been worse than the 70s. but it's going to get a lot worse. And I think the catalyst for inflation, kicking into a much higher gear is going to be a large drop in the value of the dollar versus other currencies. That hasn't happened yet. The US dollar index is still, trading around 102. I think once it cracks through 70, that was about the low in 2008, 2011 timeframe. That was a record low for the dollar. I think once we take that out, we're going to be just in free fall territory. And I don't expect the rest of the world to come to the rescue of the dollar the way it did at that period of time, or in the late mid to early 1990s, or in the late 1980s. The world really supported the dollar in its time of need and propped it up. But I think those nations that defended the dollar so vigorously in the past are no longer allies with the dollar. I think a lot of those countries now want out of the dollar. They don't want to try to go out of their way to defend the US dollar's reserve status and to maintain that monetary order. I think a lot of countries are going to, take, I don't know if it's pride or be joyful in looking at the dollar's demise, and they're going to maybe feel vindicated or feel that America is getting what it deserves. So I think we're really setting ourselves up for a currency crisis as the dollar loses its status as this reserve currency. And that is going to be the impetus for significantly higher price increases in the United States, as all this money that we have been exporting for decades, comes back looking to buy stuff. And of course, we don't make much stuff thanks to, the system. We've been running these record trade deficits. In fact, we had another horrible trade deficit that came out last week that should have tanked the dollar and would have, had it been released in the 1980s when people still cared about the trade deficits. But, right now they're not. But they are going to care once the dollar really starts to crack and these trade deficits are unfinanceable. And without the trade deficits, there's nothing to buy, because all the stuff that we buy is being imported, but we're not paying for it. We're just printing money. But when the world doesn't want the money we print anymore, then we're not going to have any ability to get the stuff they produce. And so the supply of goods is going to crash, just as the supply of dollars is going to explode. It's going to be worse than what happened with the COVID lockdowns. You're going to see a bigger supply and demand imbalance when the dollar crashes than when we just had, COVID. Because during COVID, we could still, import. Even though other countries were still locking down, we still had access to a lot of imports. The dollar went up, and so we were able to continue to consume, even though we didn't produce. But that's going to change dramatically, I think, during this dollar collapse. This morning, the dollar's up, because somebody at the Bank of Japan, even though they've got 4% inflation officially, which is the highest in 40 years, they're not doing anything about it. In fact, they're bragging about it. They're saying this is great. We dodged a bullet of deflation, so we're happy that we have some inflation now, and so there's no reason to raise interest rates. They're still negative. We don't have to stop printing money and buying Japanese government bonds. They've got the 10-year JGB pegged at about 0.5%. It was pegged at 25 basis points for a while. That they couldn't defend that anymore. So now they're at 50, but you can't defend that either. If inflation is 4%, what idiot is going to loan money for 10 years at 0.5%? But the Japanese have, backed themselves into a corner where they can't fight inflation, so they might as well welcome it and pretend that it's a good thing. But the question is, when are the Japanese people going to revolt about having too much of a good thing? Because inflation is going to keep getting worse in Japan, just like it's getting worse in Europe and the United States. And the reason that inflation is a problem all around the world is because politicians and central bankers made the same mistake in Europe and Japan that they made here. I mean, that's why it's a global problem. It's not that it absolves these politicians. If you hear Biden talk, he'll say, well, there's inflation in Japan, there's inflation in Europe, so it's not my fault how we have inflation in America. Right? No, it is his fault, and it's the Fed's fault, because the politicians all over the world made the exact same mistakes, and now they're all suffering the same consequence.
Just a quick note on the dollar collapsing. If the U.S. hyperinflates, Peter, wouldn't it be logical to assume that other countries also hyperinflate, and so vis-a-vis other currencies, the dollar would be relatively stronger still?
No, because I think the reason that we would have that type of inflation would be because of the dollar's decline relative to these other currencies. So that's my forecast, because the dollar has been artificially propped up based on its reserve status. And America's ability to run these enormous budget and trade deficits is a function of that status. The rest of the world has not run these trade deficits. In fact, by definition, they've run surpluses. The only way America can have a deficit is if somebody else has a surplus. So we are in a uniquely vulnerable position. Europe, Japan are not in this predicament. America is by itself. And so I think while the whole world is going to suffer high inflation, it's America that potentially risks hyperinflation, or at least an inflation rate that is much higher than what you're going to see in the rest of the world.
How would you evaluate the statement, Peter, that technological advances are inherently deflationary, in the sense that as technology progresses, we have more productivity, and perhaps our way of life becomes better as high-tech things become cheaper? Think TVs, your phones and computers. Yeah, I'll let you answer that.
Well, exactly. I mean, my only argument would be the term that you're using, deflationary, because in actuality, a deflation is a contraction of the money supply and inflation is an expansion. But your point that technology is a force to lower prices is absolutely correct. I mean, that describes capitalism. The beauty of capitalism is that it constantly reduces prices. That's how living standards go up, because businessmen and women are able to find more efficient ways to produce more goods and services. And as businesses become more efficient due to capital investments and increased productivity, consumers enjoy the benefits of that by getting lower prices. And so prices are supposed to go down. That is the natural tendency in a free market economy. If you look at the United States and take a look at the CPI in 1800, and then you look at the CPI in 1900, 100 years going by, and the 1900 CPI was about half the 1800 CPI, meaning prices had been cut in half over that 100-year time period. That's great. I mean, that was good news for Americans. That's why the idea that we need inflation, this is something that governments have been able to fool the public into accepting, and central banks, that we need prices to go up. And that if they don't go up, it's going to be economic Armageddon. That's just a lie. It's a self-serving lie, because the politicians want inflation, not the public. And they're just inventing a reason to try to market the inflation that they need as something that's beneficial for everybody else, but it is not. Now, here's what happens. You have two forces that usually are going on simultaneously. You have the free market, which is lowering prices, and you have the government creating inflation by printing money, which is raising prices. And right now, often the government creates so much inflation that it more than offsets the decline in prices that the free market would have otherwise delivered. So let's say the government didn't print any money, didn't create any inflation, prices would have gone down by 5%. Instead, they create 10% inflation, or let's say 7% inflation, and prices go up 2%. And they say, hey, this is great. We hit our 2% target, right? We got 2% inflation. Well, it's really 7%, because we were robbed of the benefit of being able to buy stuff for 5% less. Instead, we have to pay 2% more. And so the difference is 7%. Now, it's possible if we undergo such a massive increase in productivity, let's say that we became so productive, maybe this, artificial intelligence will be something akin to an industrial revolution, and maybe it'll make us so much more productive that prices should have fallen by 10%. right? Now, if instead they go up by 2% again, it's 12% inflation. But if prices end up going down by 2% because the government only created 6% inflation, and the free market reduced prices by 10% or 8% inflation rather, and prices dropped by 2%, that wouldn't be a disaster. Oh my God, we need more inflation because prices went down. They would have gone down by a lot more had the government not created inflation. But all of that would have been a positive for everybody. I mean, the government tries to pretend that prices going down are a bad thing. But we all know that they're a good thing. Everybody wants prices to go down. Everybody is happy when they could buy something for less money. We're upset when we have to pay more, and nobody wants higher food prices. Everybody wants lower food prices. Nobody wants higher energy prices. We all want lower energy. We're not happy if college tuition goes up. We would just assume it go down or at least stay the same. But certainly we would like to see it go down. I mean, everybody would like to see their cost of living go down, except the government. The government is convinced that we all want the cost of living to go up. But, of course, they never explain it in those terms, but that's basically what they're advocating for when they say we need inflation. We don't. We need free market capitalism, and that lowers prices, which results in rising living standards.
Well, yeah, let's talk about living standards for just a minute here. Now, are the real costs of living going to go up? I mean, I wouldn't care if the bubblegum pack, the pack of bubblegum that you were talking about is $1,000 if my wage is $1,000 a minute. Is that going to happen?
Well, obviously, wages are going to go up along with prices. The problem is they rarely go up as much. And so in a highly inflationary economy, which is also a very inefficient economy, it's very rare that the price of labor would keep up with the price of a lot of other goods and services. And so even though you're going to get a raise, in real terms, you're going to get a pay cut. But of course, a lot of people are living off of fixed incomes. They don't still work. They've retired, and their retirement income becomes eviscerated. They have no chance really of recapturing that, as well as savings. I mean, people have savings. They have cash value in an annuity or in an insurance policy, and that gets completely wiped out from the high inflation. So there are some huge losers in inflation. Now, of course, there are winners. The winners are the debtors because their debt gets wiped out. And of course, the biggest debtor of them all is the U.S. government. So the U.S. government has the most to gain by inflation, which is why it has the most incentive to create it, which it does, but then it lies about it so that it doesn't have to get the blame.
Well, let's close off on your outlook on asset classes and investment implications then. We're living in an interesting time because for the first time since, I think, 2009, we're living in an environment where we no longer have zero interest rates. Do you think now is a good time to be rotating into fixed income and high yield because of that?
Well, I think most fixed income in the U.S. is still fixed at a rate that's much too low, below the rate of inflation. So I don't look at that as attractive. But I do agree, and I've been advocating for many, many years, that investors look for investments that generate income. I just don't like the income in the United States. I don't like the income to be denominated in US dollars. And I don't like it to be fixed because I know that in an inflationary time period, you need income that can go up. You don't want your income to be fixed when your cost of living is not. So I've been advocating investing in companies around the world that have good earnings today, not companies that may have earnings in the future under certain circumstances. I want companies that have a long history of profits and that are likely to continue generating those profits and paying those dividends to me and my clients as shareholders. But I also want companies that are selling goods or providing services that their consumers need and will pay for. And if the prices go up, they'll keep buying. I mean, they may lose a few customers who can't afford it or have to cut back, but they're going to continue to be viable. I don't want to invest in businesses that depend on discretionary income, where yes, customers will buy, assuming they have enough money left over after they buy all the things that they need. Maybe they'll buy these other products. Well, maybe they won't because they can't afford them, right? And so I don't want to invest in companies that are selling the consumer, what they want if they can afford it. I want to own companies that are selling the customers what they need, and they'll eliminate other things in order to buy it, right? So I'm buying these companies that will pay reliable dividends, good dividends. Now the dividends that we're getting are far in excess of what you would get if you bought U.S. government bonds or corporate bonds or any comparable type of interest generating investment. The difference is if those are fixed, inflation can destroy the value of your income streams and of course of your principal. Whereas in my international stocks, I think my stock prices will rise more than the cost of living, and I think the dividends will increase in line or faster than the increase in the cost of living. So I think people will be able to maintain their relative standard of living by incorporating my investment strategy of dividend paying non-US companies, and also companies that have an exposure to natural resources, companies that will benefit from inflation in that it makes the value of the resources that they own and that they're selling higher. And so that would translate into gains for the shareholder.
Let me just give you a hypothetical example. You're talking about companies producing things that everybody needs. Suppose I'm a tech startup. I've got this new hot AI product. Maybe it's a humanoid robot that can, do whatever you want it to do. It'll enhance your productivity. Everyone wants it. It's hot. The problem is, Peter, I'm operating at a loss because I'm expanding so aggressively. But I promise you, Peter, in 10 years, I'll start making money. You're not going to jump in on this?
Well, first of all, look, anything that can increase somebody's productivity right now is valuable, because if I could buy something that increases my productivity, assuming that you could sell it to me at a cost that's lower than my net gain in productivity, then I'm willing to buy it. So that type of business might succeed. But if you're talking about a business that is trying to raise money to potentially develop some type of AI program that in the future may actually increase somebody's productivity, but right now it doesn't do anything but expend money, yeah, that company's going to have a hard time attracting capital in today's environment. But what I'm talking about, when I talk about stuff that consumers don't really need, right? There's a lot of things that you buy and everybody buys that they could do without. Right? I mean, if we can afford it, great, right? But if we don't have the money, well, we're going to cut back, or we'll do less of it, right? Those are the vulnerable businesses. And a lot of those businesses too, trade at 30, 40, 50 times earnings, when some of them don't even have any earnings. So the valuations are up in the stratosphere. So there's a long way for those stocks to come down. And they don't really pay much or any dividends at all. So how are they going to help you with a rising cost of living when they don't provide you with any income to live on?
You mentioned non-U.S. stocks. Why non-U.S.?
Well, for many reasons, but I find that the valuations internationally are much better. You can get a lot more for your money if you invest internationally. But also, I want income that's not dependent on the American consumer or the U.S. dollar, because I think the U.S. consumer is in trouble and I think the dollar is going down. So I want to own businesses that operate outside the U.S. and that can earn their income in currencies that I believe are going to gain in value relative to the dollar, because that means when I get to repatriate those dividends, when they get translated back to dollars, if the currencies that are the source of the income are increasing relative to the dollar, then when they get converted back to dollars for me to spend in the United States, I end up with a lot more money. I get more dollars for my euros or for my yen or whatever currency I'm earning my income in.
CBDCs are coming, central bank digital currencies, where about 114 countries are working on them. A lot of countries already have them, mostly in the Caribbean. The Fed is developing a Fed coin. The Bank of Canada is developing a Bank of Canada CBDC. Is there a way to capitalize on this? I'm not asking you to buy Bitcoin. I know what your answer is. I'm not going to go there today. But just the coming of stable coins and CBDCs and digitizing fiat, is there a way that an investor could profit from this, or is that just something that's going to you live with and don't worry about?
Well, look, I think that all the government is going to succeed in doing with central bank digital currencies is maybe have a more efficient way to create inflation. Fiat currencies made of paper were an abysmal failure, and just converting them into a digital version of the same flawed concept isn't going to be an improvement. To the extent that digital currencies were backed by real money, backed by gold, that would be a big improvement. But none of the central banks are talking about doing that. Now, maybe one of them will. Maybe it'll be China. Who knows? But I know that the private sector is already doing this, and more private companies will be coming out with digital currencies backed by real money, gold, which is completely legitimate, and I think a great innovation and a major improvement over what we have now. Certainly a big improvement over Bitcoin and other fiat cryptocurrencies that, like the dollar or the euro, are backed by nothing. But like money used to be, like currency used to be, they're backed by gold. And that's what gave the original currencies their value. It was the fact that they were backed up by gold. But if you take a digital currency and also back it by gold, you have all of the the positive attributes that people are looking for from a digital currency. It's portability, it's divisibility, it's fungibility. I mean, it's got all the advantages of Bitcoin, except it could do it cheaper and faster without any of the drawbacks, because you actually have real value that you can store as opposed to a make-believe fantasy. And if you have real gold behind your digital currency, not only is it a store of value, but now it's a unit of account, a medium of exchange, and all that, which is what we want. But I'm afraid that the central bank's versions of fiat are going to actually make it worse for ordinary people, because not only will it probably result in an even faster expansion of the money supplies, meaning more inflation, but it's going to give governments even greater control over the population. It is inherently a very oppressive move on the part of governments, especially if they succeed in eliminating cash. Because if they eliminate cash and force everybody to transact digitally, they know every single transaction that every person engages in. And that is inherently a tyrannical, dangerous type of power to allow governments. And again, not that I'm upset about it because it might make it harder for criminals, right, to commit crimes. It's law-abiding citizens that I'm concerned about, who may do things that are not crimes, but a criminal government may convert them into crimes. Or whenever a government becomes corrupt, there is usually some type of rebellion of freedom fighters that want to resist a tyrannical government's usurpation of power. They may want to organize some type of resistance. Well, that's going to be very difficult to do if you can't spend any money without the government knowing exactly what you just bought. I mean, the easier it is for the government to keep tabs on people, the more likely they are to oppress those people. If people potentially have a way to fight back against government oppression, well, then governments might not be as oppressive. So that's the whole idea. You need, people to keep the government honest, right? I think it was a Jefferson quote that when the people fear the government, there is tyranny. But when the government fears the people, there is liberty. Well, the government's not going to fear the people if it can spy on all the people and knows exactly what every person is doing. So I don't like, surrendering so much of our individual liberty to government to be able to know every single thing that we do. Now, of course, people will try to get around government snooping, but they won't be able to use cash. So what are they going to use? Well, maybe they'll use gold and silver, something like that. They have to find some way to get out from under the prying eye of government, especially to the extent that the governments become very oppressive, which is one of the reasons I tell people to buy your silver now, especially 1 ounce coins, junk silver, in case you do need to use your silver as a medium of exchange. And one reason you may want to do that, let's say we have runaway inflation and the government imposes price controls, which they may do. And let's say there's price controls on all sorts of food. Well, the food's not going to be there. The food's going to be shortages. And if you want to eat, maybe you're going to have to go to a black market and buy your food illegally. Now, do I think it's a crime if someone is hungry and they have to go and they buy food on a black market? Do I think that person should be locked up as a criminal? Do I think that, if somebody is selling food on the black market because it's the only way they can sell it at a profit, do I think that that merchant or that farmer should be locked up because they're selling food? No, I think the government is breaking laws by imposing these price controls in the first place that are unconstitutional and illegal. But the only way you'll be able to transact in this, black market is if you have a currency that they can't track. Because if you're using a central bank digital currency and now you go and you buy some food, they're going to know that you just bought this illegal food, and they're going to be able to come arrest you, or they're going to arrest whatever farmer or whatever merchant committed the crime of selling you that food, right? So, the only way that people will be able to transact without getting locked up is if they have some type of means of exchange that the government doesn't know about, right? Now you say, oh, Peter, see, you're advocating that people break the law. Well, I know it's better than starving.
No, you're advocating people
sometimes the laws are bad, right? Sometimes you get bad laws.
You're advocating people buy Bitcoin on a decentralized exchange, but no, I'm not going to go there today. Final point, you brought up gold, and I'll let you go. Gold, stocks, you think gold will beat stocks this year?
Well, I think gold will beat...
Well, during this depression, maybe not necessarily this year, but during this depression.
I think gold will beat the S&P. I think it will beat the NASDAQ by even more. But I think gold stocks will beat gold. I mean, gold has been beating gold stocks for a long time. But I think it's time that gold stocks. So if you want to buy stocks, you can just buy gold stocks. I think those are going to be the best performers. Now, there's a lot of risk there. So don't, you can lose money buying gold stocks. I mean, I know I've done it, right? But I've also made money buying gold stocks. And you just got to be comfortable with the risk. We manage a gold fund, the Euro Pacific Gold Fund. Adrian Day is my portfolio manager. I think he's done an incredible job of building a great portfolio. So I think we're really well positioned. In fact, you ought to talk to Adrian on your program. He's a really good guy to talk to about the mining sector. But I think we're really well positioned. I think we're in the early stages, of a big bull market, in gold stocks. And, I think you crypto guys, you got the right idea. You just got the wrong execution. You can just get rid of some of these currencies. And if you want to, go to the moon, you can do it with some of these gold stocks. You're not going to do it with Bitcoin or these other cryptos. You're going to go in the other direction. But if you want a big possible, home run, that's the way to do it. You want to bet on inflation and the demise of the dollar. I think the best way to do it now is with these gold and silver mining stocks. So you can buy my fund, Euro Pacific Gold Fund, anywhere, any of these discount brokers, you can buy it. You can also contact my asset management company, Euro Pacific Asset Management. We do separately managed accounts too for people managed by Adrian in gold and silver stocks. And we have income portfolios, value stocks, dividend stocks. My dividend strategy won an award last year. We were the best performing fund out of like 350 international funds. Morningstar, Lipper, U.S. News and World Report, a lot of endorsements of my dividend strategy and my mutual fund from last year. I think this is going to continue, and I think the absolute performance is going to improve as the dollar really starts to fall and we start to see a much bigger rise in the price of gold.
Interesting. Oh, yeah, we got to get Adrian on to talk about gold stocks and mining. But excellent show, Peter. Thank you very much for your time today. Where can people learn more about your work? You've got an excellent YouTube channel, which I'll put the link in the description down below. Where else?
Yeah, well, my YouTube channel, Schiff Report, I think it's called, or the Peter Schiff Show. Yeah. My podcast is on schiffradio.com. I started doing them live again just recently when this new financial crisis started. That nobody wants to call it a financial crisis but me, but that's what it is. But ever since the beginning, I went back to the live format. So I'm doing my podcast, usually a couple a week, sometimes more. But you can listen to them, watch them on YouTube, on schiffradio.com, on any of the platforms that have podcasts. So you can follow me on social media. I am on YouTube. I'm also on Facebook, Instagram, TikTok. Twitter is probably my most prolific platform. I tweet on there a lot. I am honing in on 1 million Twitter subscribers now, almost at 950,000. So I'm going to crack that million mark at some point this year. So if you're not following me on Twitter, start following me and get your
didn't know-
friends to follow me.
I didn't know you have a TikTok. Do you dance in your TikTok account? Like, what is?
No, you know, I'm not a teenage girl, so I don't do any of that. But it's this. I do the same stuff, but you know, there is more videos on there. But I'm trying to educate the young
Sure.
people on TikTok about economics. Hopefully, the U.S. government doesn't succeed in banning TikTok, so that people can continue to make the free choice of using TikTok. I mean, pretty much everybody who uses it probably knows that the Chinese own it by now, and if they want to use it, you know, they can go on using it. You know, it's none of these laws are about hurting the Chinese. They're all about hurting Americans, right? All these laws that they pass to limit the ability of Americans to use products or to buy and sell from other people, including the Chinese, they don't hurt the Chinese. They hurt Americans. It limits the choices and the freedoms that Americans have. And Americans should oppose that.
Well, a topic for another time, Peter. But excellent points today. Thank you. We'll put those links in the description, your fund links and your social links. Thank you, Peter, for coming on my show. And best of luck to you. We'll speak again soon.
Oh, thank you. And best of luck again with the David Lynn report. Hopefully it's a big success.
Thank you. And thank you for watching. Stay tuned. Don't forget to subscribe.